couple of minutes away now from producer price index, also jobless claims. Futures are flat on the session, although we have seen rates moderate just a little bit. Last time we looked at it, like 420 now or so on the 10-year. We'll take a look. See if I can confirm that. 4.206. We have seen Bitcoin rally to new highs, and it's pulling back just a little bit this morning. Rick Santelli is standing by at the CME in Chicago. It'd be good to talk to him. And Rick, you can just fill us in on what the PPI includes, what it doesn't include, how it differs from the CPI, whether you see different impacts of tariffs and on import prices. It looks at different things.
Yeah, no, and there's a whole host of new vernacular and terminology we're all becoming so comfortable with. Factory gate prices. So what we're going to be watching is, when it comes out of the factory, before anybody really touches it or does anything, we want to see what those markups are, how that effect is on the producer side with regard to pricing. So that's very important versus the end result on the consumer after it passes through a number of various entities. So on this part of the early form of production, it gives us an idea what might be in the pipeline for future pricing pressures. And even though it's been very sticky on both CPI, PCE, producer price index, ultimately, what the stickiness is caused by is where the debate lies. Is it going to strictly be tariffs? Do remember, if a price goes up and then it's steady, there's no inflation after the initial jump. That's the way the numbers are calculated. It's the rate of change. So we got to be very careful how we look at some of these numbers. We're a couple seconds away, folks, from our July release of the Producer Price Index. Headline number is whoppingly big. Oh, my goodness. Up 0.9%. Up 0.9. And if you strip out food and energy, guess what? It's still up 0.9. Boy, that equals June of 22. You're to March of 22 on the headline to find a bigger number. On the core number, that would comp to March of 22, since we've had a number of that magnitude when it was 1.2%. These are kind of COVID distorted numbers. Now, let's look at ex-food, energy, and trade. Triple the expectations. All three of those were expected to be up 0.2. This is up 0.6. 0.6 would be the highest level since March of 22 when it was 0.9. Now, let's go year over year. These are warm too. 3.7, excuse me, I'm getting ahead of myself. Final demand year over year is 3.3. We're expecting 2.5. Now, 3.3, that would be the highest since February. The high water mark was January this year at 3.8. Now, 2.8 is ex-food, energy, and trade. That is definitely higher than the 2.5 expected. 2.8 will be the highest since March. And right in the middle there, we have X just food and energy. That number coming in at 3.7. I kept it for last because that really is a very, very large number. 3.7, well, that would be the largest since March when it was 3.9. So we see every single metric is warmer than expected. Every single metric is significantly higher sequentially. Now let's go to initial jobless claims. Here's a bit of good news, 224,000. That's down 3,000 from a slightly revised 227. And we're the 12th consecutive week above 1.9 million. And continuing claims, 1,953,000. Once again, it all gets stacked up pretty tight. What we're thinking about is these numbers go all the way back to November of 2021. And the next jump up from these numbers will be when we pop over 2 million. The last time we did that was, as I said, Nova 21, 2,041,000. So we saw interest rates move up to this kind of 4.25 level in 10s. The 2-year has moved up to a bit to 370, and every maturity now, except for 30-year bonds, are higher in yield. 30-year bonds are virtually unchanged. Next week on Wednesday, we get a 20-year, but on the supply side, it's a bit in the rearview mirror. We didn't have terrific auctions, and I'm going to throw it back to you guys. I'm a little surprised the markets haven't moved more on it, but the knee-jerk is usually against expectations. The residual trade down the road here today will be about how this factors into the bigger picture.
No kidding. Yeah, the 10-year, that's not it. But the 2 years, Sorka, what day is it? Thursday?
Thursday, the 14th.
How's your institutional memory?
Lousy.
It is. It's horrible. I can tell you. I can tell you what we talked about on Monday. We went from total inflation phobia to where, and you were uncomfortable. We talked about.
Yeah, I remember.
We flipped. We were at 180 degrees. From, I mean, even yesterday or 2 days ago after the CPI, how did it happen now, Steve? Why would it be reflected in this number? And give me the Fed futures, too, because we're
calculating them as we speak.
It's the 16th and 17th is when the Fed meets next month, right?
Yeah.
So we'll have another jobs number.
Right.
And we'll have another PPI, CPI read before then, I think, too. But does this throw things off track?
Absolutely. Absolutely it does, because Rick ended his discussion by saying we'll have to see how all this fits into the big picture. I see that as being essentially we have to see how this fits into the PCE. We get parts of
we don't know?
PCE. It's being calculated now as we speak, Joe. You don't pay for the express service. You only pay for the... Anyway, the point is that parts of the PCE are calculated from CPI. Other parts come from PPI because it's thought to be better data. That's why the Fed likes the PCE, because it takes the best data from both, and we don't know. What we do know is that the PPI coming in hotter than expected likely means that this PCE will be hotter than expected. But I want to actually make Rick's point for him. My point all along has been there is no immaculate taxation. Somebody's going to pay.
Right.
Prices are going to go up.
Right.
But that doesn't change the important point that Rick made. Just because you have a one-time price increase doesn't mean you have an inflation problem. This, Joe, is exactly what the economists thought was going to happen. Okay? You were going to have three people along the way, your exporters, your importers, and your retailers. Somebody was going to pay it somewhere along the way. It has to show up somewhere. The U.S. Treasury, I don't mean to be so excited about this, is not collecting $29 billion of tariffs that no one is paying. Somebody's paying it, and now we're seeing that there's some increase in prices here.
$29 billion of future tax collections.
Yeah, it's fine. It's fine. But the point is that
the government needs to spend all this money. You had the House Minority Leader on. Maybe this money could help pay for some of those things. They're going to get us in the wallet one way or the
Rick,
other.
then you should be out there telling the president he shouldn't be sending this out as some kind of dividend, which he talks about.
Well, you know what? We should tell that to everybody in Congress, all 537, including the president, the vice president, because that's what everybody does. That's why the distortions of when you lower taxes, they say, oh, my God, it's going to create bigger deficits, only because they overspend their savings. They all do it, Andrew. I agree with you. They all do it.
Did you get claims, Rick? I can't seem to find claims. Oh, I just called it up. Hold on.
Claims are 224,000. Yeah,
down
very
3.
well behaved. 1,953,000.
There's a whole other
consecutive
debate.
week over 1.9. Yeah.
There's a whole other debate. Maybe we'll have it tomorrow about what's going on in the jobs market. Are jobs healthy or solid, as some officials say? Is it a sign of worry what's going on? It's a different debate.
You got Fed futures yet?
I do. I have it down a bit, but I'm asking my producer to calculate it one more time. I have it at 93, down from 100, essentially. So it came down a little bit for September, came down a little bit more for December, and they priced for October, and they priced out right now at 44%, the third cut. Right. So that's where that's what we're thinking right now.
Rick, I didn't even try with Leader Jeffries. He wants he's mad because prices aren't actually coming down, but failing to say that they went up to these levels because of 40-year highs and inflation of 9%. And now they're here and they're only rising, 2.7 2 days ago, higher in this number, but they're never coming down unless there's a recession, right? We don't want.
No, it's the compounding
deflation?
nature. It's the compounding
So what are they
nature.
talking about?
Yeah, I don't know. Every a month when I do CPI, I always give the actual indices that go back, over 100 years on one of them, not on the seasonally adjusted. And both of them are every month are pretty much at all-time highs. So you're right. We may go sideways some months. We may even have small downturns. But for the most part, what everybody watching hates about pricing is the fact that it compounds like compounded interest. And even when it shuts itself down, yes, going down is a whole new ball game that we never talk about, that the Fed isn't even concerned about. The Fed doesn't care if prices really go down. They just want them to stop going up.
Hey, can I just make a point. There's an anomaly in the data here from what I thought was going to happen. I thought what was going to happen was this area called trade services, it's a measure of profit margins, would squeeze and actually exert downward pressure on wholesale prices. I think that was an expectation across the street. But these are big numbers. Trade of private capital up 4.5%. Trade of personal consumption goods, what the margins that they're making, all of them up big. And I don't quite understand why the government is saying that profit margins increased when we're not seeing essentially a lot of inflation in the consumer prices, but we're seeing prices higher on the wholesale prices. That should compress margins, and we've had a whole bunch of companies come on and say we're taking big hits because of these tariffs. So this number should be going the other way. I'm not sure what's happening here, but Rick has also reported, and it's worth saying, that even if you take these trade services out, the PPI was hot anyway, but this should have exerted some downward pressure, and it didn't. Real quickly, I'll be asking St. Louis Fed President Alberto Musalem about these numbers and much more later this morning at 10 a.m.
Right. Thank you, Rick and Steve. Now what? Oh, Andrew, we have a panel.
We do. You ready for this? Kitty Richards, former Treasury Department official in the Biden administration. Also, Josh Ruha, Stanford Graduate School of Business professor. Good morning to both of you. You've been listening to this debate. You've seen these numbers. Kitty, I'll start with you. What do you do about it if you're the Fed?
I think that the Fed is going to have a difficult time meeting those investor expectations of a rate cut. I actually want to focus on what we were just talking about, this difference between the CPI, which is only starting to warm up, and the producer price index, which just came in very hot. And part of what's going on there is that there is a bit of a timing mismatch between when consumer prices rise and when producer prices rise. So I think that the Fed is going to look at this and that CPE release that's going to come later in the month and say, ooh, we're not really sure what's going on, but it looks like there are going to be price hikes coming down the pike. I'm actually not surprised that we didn't see compression of corporate profits. That's something that's characterized the inflationary period since the beginning of the pandemic, that corporations are actually able to protect their profit margins and actually even increase their profit margins at times using inflation and uncertainty as cover for price hikes, even if their costs aren't going up. And so one of the things we're going to be looking for in the CPI as consumer prices are starting to rise is, are corporations actually taking hits, or are they able to use this moment of supply constraint created by tariffs and uncertainty created by the Trump administration to pass on higher prices even above their increased costs?
Josh, what do you say?
Well, it's a toasty number, Andrew, but I think this PPI index is pretty volatile. I don't think you can read too much into this. One thing I noticed that we haven't mentioned yet is that the services component is actually up more strongly than the goods component. And if you're thinking it could be about tariffs, well, you'd expect to see more in goods. So I think it generally reflects possibly somewhat hotter demand than we had thought. It may slightly temper what the Fed would be thinking for the September meeting, but not by too much. And I also would want to underscore what you were discussing before, which is that the Fed should not be responding to price changes that would be driven by tariffs. I'm not seeing, I mean, for the CPI, you had to squint real hard to see evidence of tariffs in there. On this PPI as well, you know, I think we gotta digest the numbers. I'm not seeing it yet. So in any case, I think it's a volatile index. I think we're gonna have to wait and see what comes out with the PCE and the jobs numbers in early September, of course.
Well, here's the other question, Josh. Do you think that all of a sudden these numbers come this September are going to be politicized?
Well, I think people may be discussing that. But it remains to be seen, you know, what's going to happen there with the BLS. I don't think we're entering a new era of politicized economic statistics. I think that including the current nominee, E.J. Antony, you know, I don't think the issue with him, in my opinion, is that he would politicize the numbers. In fact, he's criticized the BLS on very valid grounds. And Secretary Besson was right when he said we can expect better from our statistical agencies. What I do think about E.J. Antony is that some of his statistical analyses are not of the highest quality. I'd like to see somebody really high quality in that job, like maybe somebody from Silicon Valley, where I'm from here.
We got to run. Kitty, you want to, final 20 seconds to you?
I think that investors should really be concerned about A.J. Antony, and we're seeing economists across the political spectrum, including folks from the American Enterprise Institute and other more right-leaning think tanks here in Washington, voicing the same concerns that he's not a high-quality candidate, and he is in the tank for Donald Trump's desire to have numbers that support his political agenda. And I think that's really, really troubling, because the investors who watch this show, for example, rely on this data being accurate and timely and not being manipulated so that they can make good decisions about where to invest. And it should be really troubling to folks that we're seeing the politicization of our data gathering agencies. My hope is that those concerns are shared by enough members in the Senate, in the Republican Party, and that they are able to stand up to Donald Trump on this issue. Otherwise, I think that we're going to see more moves like this.
Kitty and Josh, want to thank you both. Appreciate it. Coming up next, investors, they are seeing a deer in the headlights, that is. Plus,